estate. I've got one of my good lenders here, Ryan Purpero, does a fantastic job. We're going to talk about a 10-1 arm today. So this is one of Ryan's, if one of his favorite loans to do. I know that we put quite a few people in them last year. Anyway, Ryan, introduce yourself. Tell us a little bit about yourself.
Yeah, Ryan Purpero, U.S. Bank Home Mortgage, serving Orange County for just a little over 18 years. Lucky enough to work with Kevin for over a decade,
Lucky,
and
lucky.
well,
He's in front of me now.
sometimes no, but yeah, so just primarily focused on purchase business, but oftentimes we get into escrow and someone says, "Hey, Ryan, I love this condo, I love this single family residence. We're probably going to be here for maybe 5 to 7 years," and everyone thinks to just take a 30-year fix, which is my second favorite loan. A 30-year fix is a loan where the payment's fixed for 30 years. The payment pays principal and interest, and the rate never changes, the payment never changes,
Right.
and it's predictable.
Yeah.
But I always say don't pay for something that you're not going to use. And what I mean by that is this: if you plan on being in the house for 5 or 7 years,
Right.
there's a loan that is fixed for the first 10. It's a 30-year loan.
Right.
The payments are based on 30 years, just like the 30-year fix.
Is
But
it interest only?
you can get it in interest only.
But
But
basically, you're doing these now with principal also.
correct. So the rate is actually fixed for just the first decade. Well, what's the benefit of that? The benefit is that the rate is typically about a half a point lower than the going 30-year fix.
Yeah, if I'm not mistaken, right now we're looking at rates are phenomenal. Right now they're at 3.5%. This is February of 2020, and a 10-1 arm I saw they're under 3%.
Yeah, we definitely recently locked some folks in at 275 and
Wow.
2.875. So, there are shorter term arms. There's a 5-year and a 7-year, but I feel that those time frames go by pretty quick.
They're you blink and we're
Yeah,
gone, and we're seeing that more and more people, you know, are staying in their homes longer and longer. So when we think about a 10-1 arm or a 5-1 arm or 3-1 arm, it doesn't always happen. Life gets in the way, so
yeah,
we in turn aren't able to get that thing turned around. Then you got to refi, and if it doesn't refi,
rates can go up or
they
down,
can
and
go up, and so on and so forth. So why don't we talk a little bit about the process of a 10-1 arm versus a 30-year? All the pre-approval stuff is pretty much the same, but let's talk about that process of, so I'm going to bring somebody in from one of my open houses, and they want to buy that property that
yeah,
I have. It's maybe $600,000 property, and they in turn want to get pre-approved because they haven't done that yet.
yeah,
So and then you can talk to them about a 10-1 arm, a 30-year fix,
yeah.
a VA loan, all veterans and all that kind of stuff. But we're going to go after the 10-1 arm. So when I turn them over to you, and you in turn have that first conversation, what are you going to do? What information do you need from them?
Yeah, it's the same as if we were doing the 30-year fix. We would request documentation pertaining to income, assets. We do a 2-year review of tax returns and W-2s, and we also gather bank statements. We want to see what kind of
Right.
savings folks have and look for larger deposits. And you always want to be able to source any large deposits that have been recently made. Part of the Patriot Act, we got to source
Right.
funds involved in a real estate
Well, we're
transaction.
trying to get that buyer the best loan
Yeah,
out there. So if they have phenomenal credit, which is over 740, they in turn are going to get the best rate.
absolutely.
And so we can talk about the 2.75 rate, but that's not available for everybody.
It's
You're
not.
gonna you're gonna you're gonna have to be pretty good at doing that. So we need to make sure that we have all the documentation. So finish going through that a little bit more.
Yeah, so I think that oftentimes when purchasing a property, people think I can or cannot afford this. It's good to connect with someone such as myself. But the 10-1 arm will give you two benefits. It'll give you a cheaper monthly payment because your rate's cheaper.
Right.
But there's also an increased amortization. Well, what does that mean? It means you're paying down the house a little bit more.
Amortization. How do
Yeah,
you spell that?
I don't really want to get into that. There's a lot of Z's, and I think there's even the Batman symbol in that word. But you basically it means that you're paying down the house a bit more
Right.
per month. So there's kind of a dual benefit. But again, we review the income, the assets, the credit. We make sure that there's no long-term DROGs such as a bankruptcy,
Right.
things like this. So it's no more different than the 30-year. A little bit more difficult to qualify. We do require a 6 months assets in the bank for the 10-1,
Right.
and all the way up to 12 months if you're borrowing over $1 million.
Okay.
So a little bit tougher to qualify for in some regards, but
But it's important. So that's a big difference because when you're looking at a 30-year fix, you're looking at reserves. You talk about like some of it's like 60 days.
yeah, yes,
So 60 days versus 6 months
yeah.
is, I think, in the new math, it's 4 months longer and
Ab-
4 months more.
Absolutely. Simple terms here. I love it. But I just think you really do need to make sure that you're getting into the right loan for the right reasons. And the 10-1 arm isn't for everybody, but you have to just be realistic, I think,
Right.
with yourself on how long are you going to be here?
Right.
What's the plan?
Yeah.
Check out the 30-year. The 30-year fix is great, but if you want something that's a little bit more aggressive and not putting yourself in a really limited, time frame, I think the 10-1 is definitely for
I think the 10-1 arm is a great option for a lot of people. A lot of people are scared of it because of the 2007 2008 crash. The ninja loans, no income, no asset, no jobs. They in turn were just basically paying principal. They weren't paying in most of those loans. They weren't paying any. Interest. They just paid interest. They didn't pay principal.
Yeah. So it's again, it's fixed for a decade. So the rate won't move, the payment won't move. You'll be paying down the principal along with the
Right.
interest.
Right.
It's just, it's not guaranteed for 30 years.
The difference if they took a 30-year versus the 10-1 arm, if they really wanted to, they can take, they get qualified for the 30 also. They could take that extra money and be throwing it at the principal of the loan also,
Absolutely.
which is another opportunity.
Absolutely.
So, I mean, the whole thing is you want to get out of that as soon as possible if need be. But the opportunity is to be able to buy a more expensive home,
Sure,
or to pay less for a versus a 30-year fix. So it's important. So once we get somebody into escrow now, I in turn get the escrow going and then call you, and we're going to do what? We're looking at doing what's the next step?
the first and most important thing to do is lock in the rate.
Right.
We lock in the rate for a minimum of 45 days on a transaction, whether it's a 21-day close, a 30, or a 45. We lock the rate in for 45 days to make sure that we have this rate solidified, even if there is a delay, whether it's on the behalf of the bank or there's
Right.
a title issue or whatever. But at that point, we submit the file into processing with all those documents that we gathered from the pre-approval.
So we've put the loan into escrow, and we have a 15, 21-day loan approval as one of the contingencies that we have to release, along with the other contingencies of the inspections, the disclosures, and appraisal.
Yes.
You in turn typically order the appraisal what time frame?
Day one. So as soon as we lock in the rate, we upload the purchase contract, and the appraisal's ordered right away. And we'll have a third party appraiser head out there and give a fair market evaluation of the property. Make sure there's no health and safety hazards, such as maybe a leaning fence or peeling paint if you're doing an FHA loan. We get a fair market evaluation, and the loan is based upon actually the appraisal. The loan is based upon the appraisal. Even if the purchase price is $850,
right?
If the appraisal comes in at $800, the loan's based upon
right.
the $800. So we get that back. Make sure there's no, we have an as-is appraisal, meaning that it's not subject to any repairs or any items that need to be, modified on the property.
Right.
And then we do a lot of, things in the background that, the client doesn't have any, real direct connection with, meaning we're going to verify employment. We're going to send out a written verification to their particular employer, to the HR department. They're going to fill out, the specified salary and if there's any variable income.
So this is the information you're gathering that's then going to be required by the underwriter.
Correct.
Who's actually the one that's going through the each line of the process of the income and the how much down payment and the ratios, all that kind of stuff.
They're establishing a debt ratio, which is how much money's coming in versus going out every month. It's a game of minimums and maximums. we make sure that we meet all the requirements of the loan, and they will then issue a formal, conditional loan approval. But again,
Right. Right.
conditional.
Conditional. Well, it's conditional all the way through the end. I mean, bottom line, a lot of times they're calling the borrower's employer and saying, "Is John Doe still working here?" And I've had that not happen with me, but I'm very aware of other people that that person was laid off the day before,
Yeah.
and that loan was done.
Yeah, I had someone
So
actually retire. I think the week before we closed, and we couldn't do the mortgage. And the one thing is, you don't want to change anything major while being in escrow.
yeah, that can be very detrimental to the close of escrow. So after we get that done, we get the loan approval. So we've got the contingency taken off of the contract, off of the property, and then you're going to send out the CD. What's a CD?
The CD is the closing disclosure. It is the final figures for all fees involved in the transaction, ranging from lender related, title
Escrow.
Insurance, escrow, recording fees.
Insurance.
And the client has 3 full days to review the document, make sure that, hey, this is what we, are comfortable getting into, and that, they have, uh, you know, the money for the down payment, and that it all works out.
This is the CD is not really a rethink. This is just the cooling off period that the government has put into
Correct.
the process.
Correct.
So basically, after we've gotten that done, that CD is done, we're ready to close. So we in turn need to get escrow completed with all the rest of their information that they're gathering and doing, title and such. But at this point, we're ready to go, and then you guys are ready to fund.
Yeah, we send out the loan docs with a notary public signs them, usually at escrow or a place of their choice, and just verifies that, in fact, that this is the exact person that's applied for the loan.
And it's the right property, and it's all that good stuff. So
Yeah.
I think it's a good process to what we're going. But at this point, we're closing, and this is my favorite phone call to be able to call, that we're confirmed,
Yeah.
or we've sold, or whatever it is. That's what we're looking for. So Ryan, I appreciate you coming today and talking a little about the 10-1 arm.
Yeah.
We'll maybe have some additional topics that we can hit.
I hope so.
Thanks for sharing that again.
Thanks, bud.
Thanks for watching and listening. Don't forget to like and subscribe.